Middle East escalation puts global markets on edge as oil surges and uncertainty grows. As tension between Iran and Israel continues to escalate, global financial markets are treading cautiously amid growing fears of a broader regional conflict and potential US military involvement. Investors are weighing worst case outcomes, particularly disruption to global oil supply, which could cascade through inflation, interest rate, and equity performance worldwide. At the heart of investor anxiety is the specter of the United States joining Israel's military campaign. A White House spokesperson confirmed on Thursday that President Donald Trump is expected to make a decision on America's involvement within the next 2 weeks. While the S&P 500 index has remained largely stable, the energy sector is already reflecting geopolitical strain. US crude prices have spiked nearly 10% in just a week, with Brent crude climbing 18% since June 10, briefly touching a 5-month high of $79.4 per barrel. Should Iran's oil's infrastructure come under direct attack, that's when markets will truly begin to react, said Art Hogan, chief market strategist. Be really well. Current oil prices don't yet reflect the full geopolitical risk premium. Higher energy costs are likely to amplify inflationary pressures, already a thorn in the side of global central bank, according to Oxford Economics. And worst-case scenarios such as closure of the Strait of Hormuz or a full-scale halt to Iranian export could see global oil prices soaring to $130 per barrel, pushing US inflation towards 6% by year-end. In such a case, the prospect of any Federal Reserve rate cuts this year would be effectively eliminated. Rising oil prices not only threaten household purchasing power but also fed into wider volatility across asset classes. So far, this turbulence has been most visible in the energy sector, but economists warn that prolonged price shocks could eventually shake equities and fixed incomes market alike. Geopolitical risks have largely been discounted by equity markets, said a note from Citigroup analysts, but the tipping point will come if energy's commodities break higher. Despite the brewing storm in the Middle East, US stocks have shown resilience, mirroring historical patterns during prior episodes like the 2003 invasion of Iraq or the 2019 drone attacks on Saudi oil facilities. Market dipped initially but later recovered. Data from Wedbush Securities and Capital IQ Pro indicates the S&P 500 fell 0.3% in the 3 weeks post-conflict onset, but typically rose over 2% in the following 2 months. Still, analysts caution that history may not repeat if the US undertakes significant military operations, especially given current global economic fragility and Trump's own contentious trade policies. As the geopolitical friction intensifies, investors are being forced to recalibrate risk models in real time. While oil markets have already reacted, the broader financial system remains suspected between resilience and risk.